Hello and welcome. We're here today with some brilliant insights from the team at My Tax Accountant. And we're going to be talking about something that affects millions of property owners in the UK. You see, if you own property with someone else, there's a tiny little box you ticked on a form probably years ago that could be costing you thousands of pounds. So, we're going to break down the critical difference between being tenants in common and joint tenants. Let's figure out if you made the right choice.
Seriously, think about it. When you buy a property with a partner, a friend, or a family member, you have to make this choice. It feels like just another piece of paperwork, doesn't it? But getting it wrong has massive, and I mean massive, financial consequences. This isn't just about legal jargon. It's a decision that hits your wallet year after year.
So let's get right into it. Over the next few minutes, we're going to look at exactly how this one decision impacts the tax on your rental income, the profit you make when you sell up, and even what happens with your inheritance. Honestly, getting this right is one of the foundations of smart property tax planning.
Right, so there are two main ways to own a property jointly here in the UK. Let's break down what each one actually means, because everything else we're going to talk about stems from this one core difference.
Okay, first up, we have joint tenants. The easiest way to think about this is like you're co-pilots of an airplane. You both own the entire plane together. Not 50% each, but 100% together. And the most important rule is this: if one of you passes away, the other automatically gets full control of the property. This is called the right of survivorship. It's automatic, and it completely bypasses whatever is written in your will.
And then you've got tenants in common, which is a totally different kettle of fish. Think of this one more like being shareholders in a company. You each own a distinct, separate slice of the property. It could be a simple 50-50, or maybe it's 70-30, or even 99-1. You decide. And here's the crucial bit. Your share is yours to do with as you please. It doesn't automatically go to the other owner. It goes to whoever you've named in your will.
So let's just see that side by side to make it super clear. Joint tenants, you own it all together, inheritance is automatic to the survivor, and it's always an equal deal. Tenants in common, you own separate shares, inheritance follows your will, and you have way more flexibility. And that word, flexibility, well, that's the secret weapon for some really smart tax planning, as you're about to see.
Okay, let's talk about the money. Specifically, the rental income you might be getting. This is the first place where the tax implications really bite, and where picking the right ownership structure can save you a bundle right from day one.
So check this out. If you're joint tenants, HMRC says the income has to be split 50-50 for tax purposes, period. No wiggle room. So on £12,000 of rent, you're each taxed on $6,000. But if you're tenants in common, the tax follows your actual ownership split. A 70-30 ownership means one of you is taxed on £8,400 and the other on just £3,600. See the difference?
So why on earth does that split matter so much? Well, it's all about your personal tax bands. If one of you is a basic rate taxpayer paying 20% and the other is a higher rate taxpayer being hit for 40%, that rigid 50-50 split can be a real financial pain. That's not all. Here's where most people go wrong.
Just look at that number, 900 quid. That's a potential tax saving in just 1 year. On 15 grand of rent, just by setting up as tenants in common and shifting 80% of the income to the person paying a lower rate of tax, you could save £900. That's compared to the inflexible 50-50 split. That's real money, back in your pocket, every single year.
And here is a massive pro tip, especially for married couples and civil partners. Listen up, because this is a big one. HMRC's default position is to assume you split income 50-50, even if you're tenants in common with unequal shares. To fix this and have the tax reflect your true ownership, you need to file something called a Form 17 with HMRC. But, and this is important, you can only do this if you are actually tenants in common and you've got the paperwork like a deed of trust to prove it.
Now, the savings don't just stop with your monthly rental income. The really big test often comes years down the line when you decide to sell. This is where capital gains tax, or CGT, enters the picture. And guess what? Your ownership structure is, once again, absolutely critical.
The logic here is exactly the same. As joint tenants, any profit you make, what the tax man calls a gain, is split straight down the middle, 50-50. A £100,000 gain means you're each taxed on 50 grand. But as tenants in common, that gain is split according to your ownership shares. This is brilliant because it lets you allocate more of the profit to the person with a lower tax rate, or someone who hasn't used up their personal CGT allowance, which for the 2025-26 tax year is £3,000 per person.
Let's make this real. This example with Fiona and Tarek shows you the impact in pounds and pence. As joint tenants, their capital gains tax bill was over £30,000. Ouch. But by switching to tenants in common and setting up a 30-70 split to give more of the gain to Tarek, who was the basic rate taxpayer, their total bill dropped by almost £1,800. That's an £1,800 saving from one sale, all because they had the right structure.
Stay with me here. This next point might actually surprise you. We've talked about income while you're alive and profit when you sell, but what about the long-term plan? What about your legacy? This is where inheritance tax, or IHT, becomes a really major factor.
The biggest difference here is all about one word: control. As a joint tenant, the property has a will of its own, basically. It automatically jumps to the survivor, completely ignoring your will. Now, this is often great between spouses as it's simple and usually avoids IHT. But as tenants in common, your share is part of your estate. It does what your will tells it to do. You have total control over who gets your slice of the property.
So here's a quick did you know? For the 2025/26 tax year, everyone can pass on £325,000 tax-free. As the tenant in common, your share of the property gets counted towards that limit. But as joint tenants, the property passes outside the will, directly to the survivor. Now, this can be a huge plus for married couples, but it can be a real trap if you're not married or if you wanted your share to go to, say, your children from a previous marriage. As a joint tenant, you have zero control over that.
Right, let's pull all these different threads together with a real-world example. This is where you can see how getting the right professional advice can make a jaw-dropping difference to your bank balance.
Okay, meet Eloin and Idris. They're business partners buying an investment property. Eloin is a higher rate taxpayer paying 40% tax, while Idris is a basic rate taxpayer on 20%. They did what most people do. They just ticked the box for joint tenants without really thinking about it. This meant that the £24,000 they earned in rent was automatically split right down the middle for tax.
And here was their problem. Because Eloin was a higher rate taxpayer, her half of the income was getting hammered with 40% tax. That simple, default 50-50 split was creating a completely avoidable tax bill of almost £1,500. And not just once, every single year.
So, what was the fix? Well, it was actually pretty straightforward, but incredibly powerful. The advisors at my tax accountant told them to sever the joint tenancy and become tenants in common. They drew up a new deed of trust reflecting a 20/80 ownership split, which legally and formally shifted the bulk of the rental income over to Idris, the basic rate taxpayer.
And the result? You might want to sit down for this one. Over a 5-year period, once you factor in the savings on income tax, future capital gains tax, and inheritance tax planning, the total estimated saving for Eloin and Idris was over £40,000. That is the power of getting your ownership structure right. It is an absolute game changer.
So, what should you do now? What's your next move? Well, first, dig out your property deeds and find out how you own your property. Are you joint tenants or tenants in common? Second, do some quick back-of-the-envelope maths. Are you and your co-owner in different tax bands? If you are, you could be overpaying. And third, and this is the most important step of all, get professional advice that is tailored specifically to your situation.
And you don't just have to take my word for it. As Mr. Maz, the CEO of My Tax Accountant, says himself, the way you own your property is one of the most fundamental parts of tax planning. Getting it wrong can be costly, but getting it right can save you thousands. It's just too important to leave to chance.
If any of this has made you think and you want to make sure you're on the right track, the best thing you can do is talk to a specialist. You can reach the fantastic team at My Tax Accountant directly on their phone or on WhatsApp. The number is 07854 255 375, or you can drop them an email at info@mytaxaccountant.co.uk. And for more brilliant tips like these, make sure you subscribe to their YouTube channel.
So we'll leave you with this one final thought. You now know the difference between the two paths of property ownership. The big question is, which path are you on right now? And more importantly, after everything we've talked about today, are you absolutely sure it's the right one for you and your financial future?